The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data.
Today, folks, that was Jerome Powell sending all you finfluencer bears to slaughter, and this makes me want to reiterate my bull thesis on why I think the interest rate cut cycle that is now just around the corner is going to start to outperform the dividend-oriented stocks, and especially the interest rate-sensitive stocks, while big tech, the AI-oriented stocks, start to actually lag or underperform market performance. We're also going to review my 100K TFSAs. We just hit that 100K mark. Super awesome. We'll obviously broad view the entire portfolio, and if that is a conversation you'd appreciate on your path, your journey to financial independence, to perhaps one day retire early, consider subscribing to join me and hitting that like button while you're down there, because, man, just a day ago, the S&P was down about 1%, and everybody from Meet Kevin, I saw so many bear cases coming out of all these influencers scaring you from buying these dips, and of course, your boy here, always be buying these dips because I'd be making a fortune every time I do, because we're in the most bullish market ever in human history, and it always seems to persist. And I want to talk about my bull thesis here, because if you look today, especially when Jerome Powell hints toward those interest rate cuts, the bottom half of the market is performing much better than tech, and I want to talk about why that is. But firstly, we have to recognize the S&P 500 is worth around $47 trillion, with money market funds sitting around $6.4 trillion. Doesn't represent all the money in cash that's likely sitting out there in the market, so we could say that comfortably 10 to 15% of the S&P 500 is in cash, right? That's how much cash is just sitting here and comparable. So if all that money moved into the market, just the S&P, we could easily see a 10 to 15% bump, though that's probably not going to happen. Obviously, not all that money is going to orient toward the S&P 500. However, some of that money is going to be looked at as, hey, we're not getting these 5% yields that we were once getting, and now it's kind of deteriorating. We know they're going to keep cutting rates, so why don't we start orienting toward the cheaper half of the market, these dividend stocks, these interest rate sensitive stocks, the real estate, the infrastructure plays that are now going to see higher expansions in their cash flow because they're not going to be spending as much on the debt they have, because infrastructure-oriented companies have a lot of debt. So what does this mean for the big tech companies, right? Because doesn't everybody want to be a part of AI? Well, I'm telling you, it's been a bubble for a while. Doesn't mean it's going to pop. We could see some correctional periods, but a lot of these AI stocks like Microsoft are way too valued, in my opinion, for the growth that you're getting, especially off the so-called AI boom that we're currently experiencing, right? Because Microsoft, obviously the bringer of ChatGPT, you think they would be making an arm and a leg off that, but when we actually take a look at their revenue here, the revenue growth isn't an incredible place. It's between 15 and 20%. Actually, that's the historic growth rates going back to 2018 for Microsoft, yet their price to earnings multiple is trading at record highs historically for the company. They cannot be trading at record highs but not actualizing any better growth. It just doesn't make a valid investment point. It's the same thing with Apple, right? Apple's up 21% this year, beating the S&P, and if you take a look, they have like no revenue growth at all. And if you take a look at their price to earnings, it is at a record high for the most part. So these stocks are just not attractive. It's one of the reasons that Warren Buffett probably sold half of his Apple position, because why? Like, there's better value in the market right now, and especially when you look at interest rate recovery plays, because the market hasn't really started to bake in the total value of the cash flow that's going to be added over time as these companies are able to renew mortgages, adjust their variable rates, and do all this stuff that's going to lead to further cash flow. So this was one of my theses, and many of you know I sold V&Q in favor of XLU. Both these ETFs I think are going to benefit greatly. Real estate is going to come back with somewhat of a vengeance here. This is a stock that we actually bought for my parents' retirement fund. Because come on, guys, like, this isn't going to last forever, and REITs are going to start to perform better again. So year to date, we're only at 5.87%. I think we got lots of room to grow here. Obviously, in the utility sector, utilities are in super huge demand. I mean, the growth of the economy, Canada, the US, like, we need so much infrastructure to even meet the housing demand, all this stuff. So there's going to be great growth here. And this ETF just started to come back. So I think there's going to be some huge potential for cash flow expansion. Obviously, as the interest rates cut, we're seeing SCHD today. I mean, look at this thing popping up 1.3%, hitting a new all-time high for the ETF. It's only up 8.7% year to date. I definitely think we can get some better performance out of this guy. Even on the Canadian side of the border now, like, look at VDY. Up 9%. If you bought this at the beginning of the year, you locked in almost a 5% yield, or 6 months into the year, so you've actualized another 2.5% in dividends. So you've made of a dividend ETF, market average returns of 11 to 12%, which is absolutely extraordinary, right? So that's why I've been focusing more heavily on these as I cost average into the S&P. It's also why my fiance hasn't really been loading up on tech stocks anymore either. We've been really oriented toward the S&P 500, which will still benefit because the lower half is largely dividend stocks. They'll get lifted as tech might lagger a bit here, so it could see some still decent performance out of that, in my opinion. Well, time will tell. Obviously, I'm speculating on a lot of this. As we broad view, the entire portfolio has not updated for the market jump today, and I really want to start buying a little bit more XLU to kind of build that up to about a 5% position here. Again, I'm not a dividend focused investor, and I really want to iterate this. I am a total return oriented investor, but when I look at value in the market today, you have to recognize that if I can lock in an unusually high yield that hasn't really historically existed in many of these ETFs and these companies, and I can recognize that their cash flows are going to start to increase in the next 6, 12, 1 to 2 years as interest rates probably continually get cut at every Fed meeting because inflation is now under control. I highly doubt we're heading into a recessionary environment. And typically when recessions get announced anyways, the market is already bottomed. And I get people are struggling out there. The market is struggling to a large extent, but think about what interest rate cuts are going to do even for big tech companies. Now people can afford new laptops and phones. The auto market becomes more affordable for most people. Real estate starts to open back up for a lot of people that wouldn't get mortgage approvals. I mean, we're going to head back into a brand new market boom cycle here. There's so much cash on the sidelines. There's so much money in money market funds. There's so much happening here, even though the S&P is at an all-time high. However, there's one thing I'll speculate is when they start to cut rates, the US dollar will likely start to drop because when you cut rates, the dollar is going to weaken as people sell out of cash and move back into equities and stuff like that. So that's something you got to prepare for a little bit, especially if you're a Canadian investor buying over the border stocks. So just be cognizant of that because that tends to be what happens. You raise interest rates, dollar values go up. You lower interest rates, dollar value goes down. So we'll see how that kind of works into my US holdings because I could see some lack performance against converting that dollar. But however, that's why I like owning US dollars directly. And when you look at things like VFE, for example, I've talked about this before, you got to be a little bit careful, right? Because VFE has been able to outperform because the Canadian dollar is so shitty against the US dollar, right? So you're getting a little bit more performance there. However, again, if they cut US interest rates, and the US dollar starts to drop, I'm telling you right now, you could see underperformance against the S&P here. Whereas in my position, just holding pure US dollars, collecting USD, I never have to convert it. I have control over the conversion. And I could even just pull that money out as USD and spend it, even here in probably Canada, right? So I do like having that option. And it's why in my TFSA here, I have a US oriented account. I do this in all my accounts. I like really separating my currency so I have full control over the conversion when that happens or how I spend those dollars. Even if I could even invest in euro, right? And if I want to go back to Europe, I could literally pull that out and just spend it there. But nonetheless, taking a look at my TFSA, yes, we just tapped 100K today. I feel like I can't lose. Everything I touch right now is turning to gold. I've got the Midas touch. For how long that lasts, there's never a guarantee here, of course, but it's incredible to think the gains we took on Tesla, we pivoted a lot of that into VDY, especially converting a lot of that USD at a very good time. We got XLU that I recently started buying, and I even put some of that Tesla money into the S&P, and all of those have continued to move higher from where I purchased them, which means we're continuing to propel into all-time high percentage returns here, and I'm excited to see what the end of August is going to look like in this account for returns, and same with all my accounts with that CHD hitting all-time highs. Like, this is just incredible because to me, it's usually not the way people want to invest. They want to take on highly speculative investments that typically over long periods of time, they're buying the tops when the hype cycle's out there in the YouTube and influencer space. But meanwhile, if you're just like me and you're like, hey, like I like higher yields. I like that these higher yield companies are actually attractive in value and are going to see a bump in return here soon because the interest rate cuts. And like, I just love that boring investing is working better than it historically does, which is super awesome. But that leads into conversation, taking a look at the hype cycle stocks like NVIDIA. Now, NVIDIA has led the AI revolution, but it hasn't led it based off consumer spending. It has led the AI revolution off big tech spending. So we use Meta, Google. If you're in advertising, you're spending a lot of money there. If you're just a normal person, you're not really spending money on $50,000 H100s, H200 chips from NVIDIA. So when you're spending money on Google and Apple products, Apple and Google and Amazon, they're just taking your money, making those returns, and then they're giving it all to NVIDIA, basically. And that's what's led to NVIDIA's growth. Now, I'm still speculating that NVIDIA eventually will start seeing a dry up as all these big tech companies start making their own chips to make up for the supply slump. I don't know if that happens or when it happens. NVIDIA was a great buy on the dip, and we have earnings August 28th. And I'm very fascinated to see what those earnings look like. If they beat, we could continue to see this being the AI revolution-oriented company. But the rest of them just aren't doing what NVIDIA is doing because they don't have access to big tech capital, right? So it's always very interesting, and I think that's what's led to this bubblish market. In the AI aspect of things. So you just got to be cognizant. Again, just be careful if you're playing the AI plays and just understand we're not really seeing the revenue growth we need. And then we're also getting into bank earnings, which I'm very excited for. TD really only dropped. We talked about TD yesterday, and the bank sector is the most interesting to me right now because I have great exposure through VDY. And I think with TD dropping, it was primarily because they had to put more money aside for the lawsuits that they were involved with through, obviously, the crime and money laundering and whatever. But the rest of the banks don't have that problem. What we saw is a leveling off in loan loss provisions. So I think we could start to see some good earnings coming out of the big banks. I'm going to be looking for these next week as well. There's so much going on here that you should be very excited for, and it's why you should always be buying. It's why you shouldn't get caught up in the fear cycle. And obviously, I'm a villain to this as well. I post, anytime the market crashes, I'm going to be making the clickbait titles, but I'm always going to be honest with you guys about this and why you should just always be buying and don't get into the trading mindset. If you're a successful trader, good for you. It's just not me. It's not how I play this game. To each their own. Find what works for you and squeeze that lemon dry, baby, because that's what we're doing here. So stay cool, stay awesome, folks. And as always, I look forward to catching you in the next one.